Right, we're ready. So, good evening, everybody. Thank you very much for attending our webinar this evening. We managed to run this one this morning, and we managed to stick to the hour. I think we were pretty much dead on the hour. Yeah. But given this is our this presentation, we haven't really done too much of previously. There was probably a bit of waffle in it this morning, so you never know. You might be lucky, and we might be that little bit quicker this afternoon or this evening. So just to give you an intro, myself, Alex Stojkovic, one of the managing partners of Alexander Peter Wealth, and with me this evening, Paul Griffiths, based down in our office in Marbella. Paul is our Head of Europe Director of European Business. So I'm sure if you haven't spoken to Paul previously, perhaps you will do in the future. So a little bit about us as a company. We were established to help people such as yourselves that have moved overseas. Perhaps you've lived in the UK and have moved overseas into clearly Spain in this instance. But as you can probably see from this slide, we're regulated in multiple jurisdictions around the world with the focus of serving English-speaking individuals, typically that live in these countries. For the regulation that is most applicable to yourselves, clearly it's that we're regulated in Europe, but also that we are regulated in the UK as well. By the Financial Conduct Authority. So we know that clearly on whatever coastline that you are in, then there are lots of choice of advisory firms to work with. But it just, what we think that sets us out as slightly different is our ability to provide UK advice as well. So regardless of whether you're currently in Spain or you're in the UK thinking of moving to Spain, then we've got the ability to help you in whichever jurisdiction you're in, or indeed in the future, should you decide to move back to the UK, then of course we've got the ability to potentially help you as well. So what we're going to talk about today, a few different items here. We're going to look at, and I'll deal with pensions. Most of my background in financial services is in relation to UK pensions. So I'll run through UK pensions, if you're holding UK pensions, how these are taxed in Spain, the varying different forms of UK pensions versus how they're taxed in the UK. And we'll have a look at the potential opportunities that exist there. Paul will then discuss, given that we now live in a post-Brexit world, visa options, what that sort of means, the different systems that exist, which may or may not be applicable for you, but good to see. And then we'll look at your savings and investments, again, how UK cited assets are taxed and dealt with in Spain, and again how that differs from the UK. Then I will look at and deal with currency exchange as well. We won't go into too much detail on that, but we'll have a look at currency exchange. And then Paul will sort of finish things off with private medical insurance, and also inheritance tax and estate planning as well. So there's quite a bit to get through. Each one of these subjects, or sort of categories of subjects, I'm sure we could probably do an hour's session on each one of those. So we will touch upon these points, of course, and provide hopefully some useful information to you. But if there's anything that you want further, anything that you want further explaining, then we do welcome questions. So while we're running through the presentation, if you have any questions at all, please feel free to drop us a question. We'll try and answer them as best as we can while we're here. So there's a Q&A function somewhere on your screen there. You've got the ability to sort of tap into that and ask us a question as we go along. Okay, so let's start with UK pensions then. And I know lots of people will know this, but just so we're sort of covering all the bases. Effectively, there are two types of pensions in the UK, and for that matter, globally, really. Defined contributions and defined benefit pension schemes. Defined contributions, typically personal pensions, but also can be employer sponsored pension schemes. A defined contribution scheme means that both employer and employee make contributions into the scheme, or if it's a personal pension, just employee. And the fund is then invested. The funds are then invested into investment funds, which invariably are investing into the stock market and bonds. And the level of income that you will receive from that pension scheme really depends on the amount that's been paid into it, and also the performance and how well it's grown over the years that it's been invested. There are a number of different options for income that are available from a UK pension scheme, and we'll have a look at the taxation of those shortly. The other element then is defined benefit schemes, and these work very, very differently. The level of income that is deemed to come from one of these schemes, again, yes, contributions are going in from employer and employee, but rather than it being based upon investment performance, the level of income received is all based on the length of service that you spent with your employer, and the final salary that you were on at the end of your employment. Now, that might be the final salary, it might be the last 3 years' salary as an average, different definitions, but that's why these schemes are also called final salary schemes. So very, very different. And the reason we mention this is really because they are taxed differently in Spain. And as I say, we will get on to that in a little while. So schemes, before we get on to that, schemes that can't be transferred, and as I say, transferring is something that we'll look at in relation to taxation for the purposes of this presentation. But just while we're here, so schemes that we cannot transfer, that they will always remain in the UK, is number one, the state pension or the old age pension scheme, the government pension. Secondly is civil service pension schemes, those such as if you've got an NHS pension or a police pension, something like that. Those schemes can't be transferred, and that's because they're unfunded schemes. There is no pot of money that exists. So those schemes can't be transferred, as well as annuities. If you have taken out a lifetime annuity, perhaps with one of your defined contribution schemes, if you've purchased an annuity, once you've gone down that road, then those schemes are locked in. And as well as if you have a defined benefit scheme that is in payment, if you've started to take income from that and that pension has started, then again, those schemes are sort of locked in. They can't be transferred. Now, how is your pension tax? Well, in the UK, it's reasonably straightforward because each of these categories that we have here, whether it's a civil service pension scheme, whether it's a final salary scheme from a private employer, such as Shell or Barclays or someone like that, or whether it's your own private pension, SIP, or for those that have transferred into a Curops or something, then effectively in the UK, it's all taxed in the same way. So when you made contributions into that pension scheme in the UK, you would have received tax relief on your contributions. The growth inside of the pension scheme will also have been tax-free. And then when you come to make withdrawals or receive income in whatever form that comes, in the UK, it becomes as earned income. And therefore you pay tax at your marginal rates of income tax, 20%, higher rate taxpayer, 40%, etc. So it's all reasonably straightforward in the UK. The other addition that you have inside of the UK is that there is this notion, this concept of a 25% tax-free cash lump sum. So if you are a UK resident, then you have the ability to take advantage of 25% of that fund being tax-free. Now, once you become Spanish tax resident, then things change a little bit. And what I mean by that is each one of these is slightly different. So first of all, if we take the state pension, the UK government old age pension, then that will be taxed in the UK. Okay, that gets taxed at source in the UK. Civil service pensions are also, if you look at the double tax treaty between the UK and Spain, then you will also see that civil service pension schemes are also taxable in the UK. However, that income that you have received from those makes up your income in Spain. So it will affect the level of marginal rate of tax that you are paying in Spain. So the annual allowance that's available in the UK is a lot more generous than it is in Spain. Invariably, the tax thresholds or the bands that you move through, you get to higher rates of tax a bit quicker in Spain than you would in the UK. So if you've paid, let's say 20% income tax in Spain on those pensions, on that income, but that pushes you into a slightly higher tax bracket in Spain, then there may be a bit of additional tax to pay in Spain as well. Final salary pension schemes, and these other two schemes, really, to understand this, you've got to sort of understand the way that the Spanish system works and what pensions are available inside of the Spanish system. And inside of the system, there is occupational pension schemes. Those schemes absolutely exist. And then there are personal pensions that when it becomes, when you come to retire, those schemes then become annuitized. Annuities we're not going to cover in today's presentation really, but annuities attract a very low rate of tax within Spain. So if you have annuitized or are thinking about an annuity, there's definitely some advantages there to look at and consider. But for occupational schemes, final salary pension schemes, how are they taxed in Spain? Well, effectively, that becomes as earned income. They are deemed to be earned income in Spain. So what will happen in terms of a process, every UK pension scheme is effectively treated the same as PAYE in the UK. So tax will be withheld at source inside of the UK. You would then need to declare the income on your tax return in Spain. And then clearly, because there is a double tax treaty between the UK and Spain, then you have the ability to reclaim that tax that you've paid to HMRC back in the UK. Private pensions work slightly differently, and that's because really of the income choices that exist inside of the UK. So inside of the UK with SIPs, with cure ops, even in the US with IRA accounts, then we effectively have this notion of having an invested sum of money that we can then take income withdrawals from. So we haven't purchased an annuity necessarily. We've exercised what we know as income release or income drawdown. That concept doesn't really find itself within the Spanish system, and more aligns itself to savings and investment. So private pensions, whether they're any one of those three, and I would add personal pensions to that as well, will be taxed in a slightly different way. And I'll run through an example in a minute, because there are some big advantages here from a income tax perspective, effectively. As I said before, UK pensions run through the PAYE system, and therefore UK tax will be deducted at source, unless with a private pension you have declared to HMRC that you no longer live in the UK, and that you are able to obtain an NT tax code, a no tax tax code. If that's the case, then the trustees of the pension scheme, whether it's a SIP or a personal pension, will be able to then pay out that income to you without UK income tax being deducted. It will be paid out gross. So once we have the money in Spain, what does the taxation look like on one of these defined contribution pension schemes, these private pension schemes? Well, the investment income tax rates look as follows. So straight away you will notice that there is no personal allowance here. There is taxation applicable from the first euro that you'll notice, and it escalates clearly 19% all the way up to 26%. So just bear that in mind, and we'll look through a working example, because whilst that looked bad, it perhaps isn't as bad as we first might fear. So what we've done here is just pull together an example, and this example assumes that, let's say we've got a £200,000 pension, and at the end of a period, whatever that investment return period is, we have a new total value of €250,000. So we've had a growth of €50,000 in that account. That's a 20% gain. Okay, so if we take that 20% gain, keep that 20% number in mind, the percentage in mind. So the £50,000 growth, we say, hey, you know what, listen, I want to take that income, I want to take that £50,000 out of my pension for my income for this year, or to spend on, whatever it is that you want to spend the money on. How is that then taxed, this 50,000? Well, remember that the growth within inside of the fund was 20%. So when you make the withdrawal of €50,000, 20% of 50,000 is deemed to be gain. The other 80% is deemed to be just a return of capital, your original capital. So in that 50,000 example, 10,000 is now liable to tax. 40,000 is just return of capital to you. It's the original capital invested. How does that break down? Well, if you remember, the first €6,000 is taxed at 19%. Then we move up into the next band. So then the remaining 4,000 from that 10,000 is then taxable at 21%. That gives us a total tax bill from the 50,000 gain, 50,000 withdrawal of €1,980, which, what does that mean in total tax payable in that particular example? Well, it's tax of 3.96%. So if we compare that to how that would be taxable in the UK, typically that would be taxed at 20%, some of it 20%, maybe it tips over into the high rate threshold as well. That's a considerably lower rate of tax that is available if we use this investment taxation model and methodology. So with that can be some advantages. Advantages that you need to think about is clearly that tax position and how personal pensions can be taxed. If you have a pension that, let's say, is a occupational pension scheme, then of course you have the potential and ability to exercise a transfer of that pension scheme. However, those final salary pension schemes, the defined benefit pension schemes, are often described as the Rolls-Royce of pension schemes. And the reason for that is two reasons. Firstly, because effectively there is no investment risk to you as the individual. The income that you receive is solely dependent upon, as we said at the beginning, the length of service that you spent with that employer and your final salary. And therefore there is no investment risk for you involved. The other reason that they're called the Rolls-Royce of pension schemes is because that income that you will receive from that pension will keep pace with inflation. Maybe not inflation that we're experiencing today, because most of them are subject to a cap, but normal inflationary rates they will keep pace with. So when it comes to making decisions in relation to transferring one of those types of schemes, it's not something to be entered into lightly. Clearly, professional advice needs to be taken in relation to this, and actually the UK regulator insists upon that, has mandated that. So tax benefits, absolutely, potentially big tax benefits. However, as I say, not to be taken lightly, and appropriate advice should be sought if you're going to go down and consider that. Now, if you're still in the UK, as I said previously, the UK within the tax strategy and rules there has the ability for you to withdraw 25% of your pension as a tax-free lump sum. Unfortunately, that option is not available. Well, the option's available to you in Spain, it's just that it will be taxable. And therefore, maybe it's not in your best interests to receive that 25% lump sum. If you haven't yet moved to Spain, you haven't yet become tax resident in Spain, there is one big planning opportunity there for you to consider, which would be to take that 25% before you move. Doesn't necessarily mean you need to spend it and blow it on a Ferrari, but certainly in terms of exercising that so that you're not paying tax on it, that is something to consider. The other thing to consider is, if you have multiple pensions, is potentially consolidating them. There's something called rebasing, which Paul will get onto a little bit more in his investment presentation, but the same sort of concept really applies for your pension. Again, ways to minimize the amount of tax that you will pay upon your income. That's a whistle-stop tour of pensions. As I say, we could probably spend an hour or so going very deep into the weeds with this, but we've got quite a lot of material to cover. Before we move on to Paul's part of the presentation, is there any questions that anybody has at this stage?
Yeah, we got one question that's just pinged in, Alex.
Yeah.
Yeah, gentleman been in in Spain for a few years already, not yet taking pension, but's got several pensions, and certainly the consolidation part seems to be of interest to him. But they already have an advisor in the UK. Yep. Just asking if those advisors in the UK can simply do the consolidation for him.
If the individual is in the UK and UK tax resident, then yes. If they're now in Spain, as it seems to be that they are, and Spanish tax resident, then the answer is no. The simple reason for that is Brexit. So that's invariably why we now have two licenses. We have the license in the UK. but since Brexit, that sort of border has come up. But then we're now licensed in Europe as well to provide that advice. So unfortunately, the UK advisor, we're happy to work with UK advisors, and we do work with UK advisors to ensure that there is continuity of the sort of investment approach, etc. But no, absolutely, if that client is on UK soil, Spanish soil, then a European license now needs to be utilised.
That's fine. That's the only question for that section.
Okay, all right, very good. Well, either blinded everybody with science, or I was very concise, one of the two.
So I'll try to make this next session fun.
Okay, fantastic. All right, over to you.
So yeah, so we're going to be talking about visas and why. Well, look, for those of us who've been lucky enough to have already be here in Spain with residency permits and everything else, fine. But of course, look, you know, movement of people is not going to stop. You will be looking to retire. You will be still working, potentially looking to work in Spain or certainly work from Spain. So what are your options? The first one is the non-lucrative visa, very much geared towards, I guess, the at retirement market. So those who have income sources, they want to move over, settle down and look to stay in Spain long term. It's simple because all you need is to prove you've got the right financials along with a couple other bits and pieces. So the key points, and I'll keep it high level, things just to remember when applying for the non-lucrative visa is that, first of all, you have to apply from the country you're currently living in. So for those of you in the UK, then you have to apply with the Spanish embassy in the UK. Okay, and that principle applies to other countries around the world. Now, the financials, you must be able to show, and this is last year's figures, I don't think it's changed for this year, you've got to have at least 27,200 euro to be able to support yourself for 1 year. If you have family members applying as well, they need, as part of the same application, of course, they need to provide evidence of 6,800 euro per family member, okay? Along with that, of course, you can't have a criminal record. You need to also take out a private medical insurance, and it has to be a comprehensive policy, and it has to be issued by a Spanish insurer. And of course, you then need to go for a medical to get a certificate to say that, you know, you don't have any, or you're not suffering from any physical or mental illness that would pose a threat to the public healthcare system. Once you've gone through the application and you're granted, you get granted for 1 year. Typically, what you would do is you'll then extend that by a further 2 years, and obviously the financials would double for 2 years, and then you extend for another 2 years. So once you've done your 5 years, then of course you get your permanent residency. Happy days. Important to note that I say the non-lucrative is aimed at the at-retirement market because you cannot take out any economic activities here in Spain. If you are working remotely for a foreign entity, that is not a problem, as long as you're not generating any income from a Spanish source. Okay, so very important to remember. Now, for those of you who aren't old enough yet to retire, or certainly don't want to think about retiring and happily working, then you've got the self-employed work visa route. We'll just touch on the self-employed route. Again, the visa application process starts from where you were living at the moment. And again, once granted, it is for the first year. A bit more complicated because you've got to tell the Spanish authorities, you know, what's your qualifications, show your CV, got to put a business plan together about how you're going to generate your income, make sure that the turnover is going to be sufficient enough to support your lifestyle. So it's about viability, okay? And again, documents will be the same, criminal records check, healthcare check, medical insurance check, and so on, okay? Now, the interesting thing about the self-employed route, or in Spain they call it autónomo, of course, is that once you're here, unlike the non-lucrative visa, once you're here, there are some additional things you have to do. So you need to register yourself with the tax agency, which is the Agencia Tributaria, and then register yourself with the social office, of course, which is the Seguridad Social, to make sure you pay appropriate taxes and appropriate social tax as well, which is the equivalent of the national insurance, for example. So it is an ongoing process for those who want to carry on working, okay? And the very last one, which is something relatively new, and it's been in the pipeline for some time, is this digital nomad visa, which many countries in Europe have been pushing. Spain's only just sort of caught up because, legislation framework, but they're not quite there yet. But again, it's designed for remote workers for international firms who really just want to do the work, but want to live in Spain. The actual process, again, starts from where you're living currently, but how the framework on how that actually looks is yet to be decided. And this information, of course, was as fresh as last month. But it is very much designed for, again, those who are from a third country, so those with British passports, for example, work for another company, not Spain, and I want to live here. Okay, it is a good way to be doing it because from what we understand, I think the potential tax treatment could be more favorable as well. And that's because if you're living in Spain, you're taxed in Spain, you are technically taxed on your worldwide income. So just bear that in mind, okay? Now, all this information, we can certainly do a separate session, but we as a company do not get directly involved with visa applications. The information today is based on our understanding and information provided by one of our partner firms, which is Martinez y Chavarria. Now, they are a law firm based in Spain and have offices all over Spain. So should you need visa services, immigration services, and you want a law firm within your local area, let us know. And we will, of course, be providing contact details after the webinar. Okay. So yes, that's on the visa one. Right. So coming back to what really tags along what Alex has already discussed, pensions and pension tax. So we're talking about savings and investments and how one should look at it. I'm only going to do this more from a UK perspective because the first item on the list is ISAs, individual savings accounts is what they're called. And for those of us who've lived and worked in the UK, it's one of the items that we're taught to be saving and investing in. It's tax-free from a UK perspective. Unfortunately, when you become a resident of Spain, the tax-free notion, whilst is maintained from a UK perspective, Spain does not recognize ISAs, and why should they? It is not a Spanish product, okay? So whatever you have in your ISA, whether it's 0.5% interest if it's cash, or if you've got stocks and shares paying out dividends, or you've got funds that you're buying and selling, locking in capital gains, anything you do within it that I just mentioned, those actions are taxable in Spain. So you've got to file and you've got to pay the investment income tax rates of the 19% through to 26. So all of a sudden, it can be quite cumbersome. Now, we talk about if we can catch it before you leave the UK, you can rearrange your financial assets, okay? And Alex mentioned the word or the terminology of rebasing. So really, because every action within a portfolio where you're realizing a gain or there's a dividend is taxable in Spain, regardless how long you've had it for, you want to avoid that. And by avoiding that, you simply just sell what you've got currently in the UK. So if you've got an ISA and you've got a portfolio of stocks and shares, you simply sell everything. And the next day you rebuy the same assets, should you so wish. But by doing so, you reset the amount of capital. So you're locked in the gains, it's tax-free in the UK, and you buy back in a higher level, you've got a higher capital. And that really helps when you come to Spain, because when we then do financial planning or give financial advice to our clients, then it's a case of looking about your medium to long-term strategy. And if you've already done your rebasing bit, it just means that in many cases, future taxes, when we come to rearrange things, are very, very small. Or if you take this year as an example, well, the stock market's taken a hit. So if you did sell something now, the chances are you could be locking in losses, and then you can buy back in at the lower level anyway to avoid being out of the market for too long. This is important, which leads on to the fact that if you're, when you live in Spain, you got to understand that ISAs aren't any good anymore. So what else is out there? Okay, surely a country like Spain must have something that I can invest through to ensure that I get some sort of tax deference. Well, luckily, within the sort of framework of the EU, shall we say, a lot of the compliant life assurance contracts, so these are investment-linked life assurance contracts, are very similar to ISAs. In a way that as you buy and sell these funds, these investments within that life assurance structure, there is no taxation. Okay, it's completely tax-free within that structure. Taxes only occur when you withdraw. Okay, and the way that the tax actually works when you withdraw is exactly the same as the pie charts that we showed you previously. So every withdrawal you take, part of it will be the return of capital, and part of it will be the gain, and then the gain is then taxed from the 19% regime. Okay, so yeah, very vital. Before you leave, rearrange if you can. If you can't, then it's still not too late.
We've got a question that has just come up. Let me just
okay.
So we've got a question here. I have permanent residency here. I have 1 year to go until I retire at 66, but want to stop working for this last year. Will I have to sign up and pay NI contributions for that 1 year? So that's the first question, and we've got a second question. So maybe start that one.
Yeah, so really, Kevin, this is all about just double checking your state pension forecast or the contributions you've already made. And it's a simple link onto the government's website. They will tell you exactly if you've done the maximum possible. Now, if you are missing, say, 1 year, then it's actually quite a straightforward email/phone call to the International Pension Center. And they'll be able to, you've obviously give out your national insurance number. They will then tell you exactly, A, what type of voluntary national insurance contributions you can make, and B, if by making those contributions, how will that affect your entitlement?
Okay, and then the second question is, after retiring, I will receive music royalties. How and what rate will they be taxed here?
Actually, it's quite a straightforward one, this. Royalties are treated exactly the same as investment income. So if you've royalties of €6,000 in a particular year, then you pay 19%. And as Alex already mentioned, when it comes to investment income, there is no nil rate or allowances. Okay, so you do go straight in at 19% and 21, 23, and so on.
Okay, hopefully that answered the questions there. If not, then by all means, send us another one, Kevin. We've got another one, Paul. Somebody's been resident in Spain for a few years, has a stocks and shares ISA as well as a portfolio. So I'm guessing that's a sort of separate account to the ISA. How does he make it more efficient, basically?
Sure. Yeah, we get this all the time. The point is, there is nothing wrong with paying some tax now to make your life easier and better for the rest of your life. If Spain is going to be long term, then by all means, let's look at the portfolio. We liquidate, and obviously, look, this year stocks have been hammered, as you know. Liquidate, your investment income tax liabilities might be low, and then simply move it into a compliant portfolio. When it comes to ISAs, similar sort of story. You can liquidate and repeat that process. The only thing with ISAs I would probably say is that depending on your long-term outlook, if there is even a slight inkling that you might return to the UK, then I think any good advisor would be making potential recommendations to say, look, you've got, say, X amount in an ISA. We need to shift some of it certainly to make it more compliant, but why not leave some in an ISA just in case you do move back to the UK to then liquidate then, because obviously that way it's tax-free. So it's never too late is a simple answer. Okay, it's never too late because there's still a lot of advantages for you in the medium to long term.
Okay, fabulous.
Okay.
More? I think that's all of them.
Fine. Okay.
So I think we're free to move on to the next section.
Yeah, so we'll touch briefly on taxation because we have been talking about pension savings investments and how they're taxed. So we're now talking about the obligations and the types of tax that one needs to report. So the most talked about piece of reporting obligation is this Modello 720, which is basically for not just British expats, of course, it's basically for anybody living in Spain who has assets outside of Spain. And these assets are broken down in 3 categories: cash, investments, and private personal pensions also come under investments, and property. So if your cash and investments in those categories cumulatively across your accounts total at least 50,000 euro, then you need to declare. And unfortunately, it's not declaring that I have, say, 100,000 euros worth in cash. It's declaring how many accounts you've got. Same with investments. It's declaring how many different shares I've got, how many different funds I've got. So it can be quite a cumbersome exercise. In terms of the third category, which covers property, of course, you declare the number of properties you've got and the addresses when you bought them, but they're not asking for value. They're asking how much did you pay to buy that property? What was the total price? Okay, and if that price cumulatively was more than 50,000 euro, which I can only assume it would be, then you must declare. Okay, so the 720 has always been a bit of a pain in everyone's backside when it comes to reporting, and that's also because of its excessive fines. Prior to January this year, the fines were 5,000 euro for non-filing, but with a minimum fine of 10,000 euro. But thankfully, after about 9 years in the European Court of Justice, the court have ruled in January that these fines were illegal. So for anyone who have been fined and fines are paid, then at least they can claim that back. But for those who are starting out their journey, reporting, it's no longer a scary piece of reporting. Sure, if you don't report, then you would be subject to penalties and fines anyway, but they're much, much smaller now, okay? However, you live here, you are obligated to report. Now, the reporting itself is usually done between January and March. Most typically, people report it once. But if there's been significant increases in value of 20,000 euro or more, then you've got to report again. Or if there is a material change to the assets you're holding, such as the number of shares, the number of units in the funds, you've got to report again. Okay, so just bear that in mind. And then we come to the annual income tax that we all pay. Okay, so income obviously covers earned income, income from state pensions, civil service pensions, final salaries, for example. Investments cover obviously investments as well as private pensions, and of course a rental for those who are receiving income from rental properties. And these usually the tax season for these taxes filing begins from April typically, but most accountants will file in between May and June, but certainly work starts in April.
Okay. Any questions there? I think we've got one here. well, one that was posted actually beforehand, which was about, you know, what's the situation? What do you advise if, let's say, somebody's been in Spain for a number of years and hasn't declared on the M720?
Okay, well, the bottom line is that you have to declare. Okay, I think the interesting choice then becomes: do you make a voluntary late filing and potentially pay some small fines, or do you wait until January, March next year? This would be more of a personal choice and guidance, I would say, from your gestor assessor. We work very closely with Spence Clark and Co Marbella, who provide taxation across Spain. And again, if you guys do need gestors, assessors nearer to your location, do let us know and we'll provide details.
Fabulous. Oh, currency exchange. That's me.
Yeah, back to you.
Okay, fabulous. All right. So what's the time now? We are quarter two. So I won't spend too long on this particular subject matter. But for anybody that's lived in Spain or Europe for that matter for a number of years, then you will remember pre-Brexit exactly where we were in terms of exchange rate and where we were the day after that announcement in relation to Brexit. So I think just before Brexit, we were 120, something like that, sterling to euro. Post-Brexit, we got pretty close to parity. And of recent times, in actual fact, we've got back to sort of the dizzy heights of almost 120 again. I think today we're sort of trading about 115. So the point here really, without sort of bringing up graphs and slides and all that sort of stuff, is that it can have a significant effect on your buying power, your spending ability. If we take that same sort of 50,000 euro withdrawal that we looked at earlier in the presentation, well, clearly at parity, 50,000 pounds is 50,000 euro or very, very close. And at 120, whereas 50,000 pounds becomes 60,000 euro. So it can have a major impact on the amount and the cost of living as a result. Obviously, cost of living at the moment is very, very topical. What I would say is that any product that we utilize will be multi-currency. And so by that, I mean that it has the ability, whether this is a pension, whether this is an investment account that Paul sort of referred to, it will have the ability to hold both sterling and euro. So in times of sort of low exchange rates, then does it make sense to be forced to change all of your capital into euro just because you live in Spain? Well, no, it doesn't. And therefore, in those sort of circumstances, invariably funds that are brought in are in sterling, and maybe we recommend at that stage that we hold 6 months, 1 year, maybe 2 years worth of income in euro, because clearly your expenditure is in euro. And as the rate gets better, we look to phase money over into euro from sterling. Or alternatively, of course, if we are in a position whereby we're back at good rates and we're at reasonable rates at the moment, then the consideration to move a larger proportion of your funds into euro perhaps can make sense. Ultimately, however, what we're looking at really is the ability for you to have flexibility in that. And secondly, also to have the ability to not pay large exorbitant fees to banks. So when you make exchanges, and I'm sure all of you have, and then you realize how much you haven't got or how much the bank has taken in fees and commissions, it can be quite eye-watering. That does vary from bank to bank, but it can be on both sides of the equation as well. that happens. So, you know, whenever we talk about managing foreign exchange, managing currency, it is the sort of strategies that I've discussed, but also ensuring that we're exchanging at institutional rates. So we're getting as close to the spot price as possible, and not allowing the sort of retail banks to take advantage of the situation. So for me, that's, you know, as much as, given the time constraints of this presentation, as much as we perhaps need to cover on currency, but it's all about flexibility really, because none of us can control what the currency rates are going to be. We know what a good rate is and we know what a bad rate is. History tells us that, and therefore having the flexibility within inside of the products that are utilized is the crucial part in that. Okay, I'll hand back over to you, Paul.
Okay, so we talk about the need for getting the right insurance for our visas. And, you know, it is true for visas, but it's just true in general anyway, because when you first come over, you're not going to have access to the local healthcare system. So private recall medical insurance needs to be issued, of course, by a Spanish insurer. Okay, a number of insurer provides this, the likes of Liberty Seguros, for example, but also Línea Directa and a large number of others. We partner up with Dragon Insurance, who are a brokerage, and they've been providing this service for the last 20 to 25 years all over Spain. So certainly at the end of the webinar, we'll be sending out details with the relevant contacts should you need to obtain private medical insurance or other forms of insurances for that matter. Okay, so it's relatively straightforward. So we got about 10 minutes left. Just want to talk about the morbid side of things. Look, you move to Spain, do you need a will? Do you need a Spanish will? Well, simple answer is yes. If you have assets in any country, you ought to have a will in that country, really, to make it simple for yourself. Because you've got to then understand the differences between succession laws between Spain and the UK, for example. Thankfully, Spain is one of a number of countries who signed up to the Brussels IV regime. Some of you may be familiar with it, but the Brussels IV regime allows you to nominate the law of land of another country. It has to be the country where you were born. So for a lot of you, this would be the United Kingdom. So you can use United Kingdom rules on inheritance to apply for the distribution of your Spanish asset. And it's only just about the distribution, by the way. It's not about how it's taxed. So under UK rules, you can nominate beneficiaries, which is very handy if you have a slightly more complicated family, or perhaps, you know, you have a son, daughter who now is estranged, or maybe son, daughter who doesn't need your money and happy to let their sibling receive the assets instead. So the ability to nominate is very, very powerful. Okay, so you have assets in Spain, certainly have that will, have assets in the UK, you need an English, Scottish or Welsh will as well. Now, for many of us, there are simpler ways in helping managing your estate planning. And this is really focused on your movable assets. So liquid assets such as your cash, your investments. So earlier we talked about moving your ISAs and portfolio and cash into a investment-linked life assurance contract that's compliant with Spanish taxation systems. Well, it's due to the nature of that contract being a life assurance contract that actually can simplify your estate planning, because on life assurance contracts, you are able to physically nominate beneficiaries with designated percentages. And what will happen is, let's say you have a joint contract, yourself and your partner. One of you dies, your partner simply resumes control, has full access. And then when that partner dies, is then distributed to your loved ones. That's, to your nominated beneficiaries. And this is important because for those who've actually gone through the probate system, like I have, probate can take years. 6 months to 3 years currently in the UK. And that's important because all your assets gets frozen until that's completed. But a life insurance contract does not get frozen. It would be paid out in accordance to your nominated beneficiaries, which simply means that if your loved one's inheriting this money, has tax bills to pay, this bills to pay, that bill to pay, well, guess what? In most cases, everything in that life insurance, investment-linked life insurance contract is paid out within a matter of a few weeks. So it does make a very simple way to part of your overall estate planning. And of course, as part of estate planning, we then talk about, actually, Paul, what's all the taxation about? How do we, be careful about it? Well, we're going to look more on the Spanish side, and to understand it, Spain has 17 different autonomous regions, and they all have their own different rules on succession. If we look at Andalusia, then thankfully it is, well, all of them is the beneficiaries that pay the tax when receiving the estate. But in Andalusia, the beneficiary has an allowance of €1 million. Compare that to somewhere like Valencia, where I think from memory is around about 300,000. So it makes a big deal difference where your assets are based or where you're living in Spain. Now, again, I mentioned that because the beneficiary has to pay the taxes before they can inherit it, if they don't have money, how are they going to pay for it? So everything gets dragged out. Yes, assets can be sold, but try selling a Spanish property, trying to get proper value to it, it's not always that easy. So it can get really, really a long drawn process. That's why if you're in a fortunate position where you do have liquid assets in a life insurance contract, then sure, that can be paid out and they could utilize that money to help pay the tax bill accordingly. Okay. And of course, the common question we also get is, right, okay, Paul, I die in Spain, but I'm UK domicile, which means the UK system taxes me on my worldwide assets. Well, that is true. The estate bill that your UK estate would pay can now offset some of the Spanish liabilities. Simple answer is yes, it can, but it is quite complicated depending on your personal and individual situation. So that's pretty much all we want to say on that subject, because this area does require a more bespoke piece of financial planning advice. Okay, but I think the takeaway here, ladies and gentlemen, is the fact that do your estate planning where you possibly can in terms of your liquid assets. Not much you can do about your property because you've got to live in it, but certainly your liquid assets can be managed in the correct way, that it can be distributed properly and in an efficient manner.
Fabulous. Thank you. Okay, so I think we are just about there. So just to sort of recap on what we've done, what we've discussed, the sort of takeaways, pension, different forms of taxation, different system to the UK. There are potential advantages of bringing your pensions into a sort of personal type of arrangement, whether that's a SIPP, whether that's a QROPS type arrangement. There is the potential tax advantages in doing so. However, that shouldn't be taken lightly, of course, given that there are potential benefits to that scheme that you have in the UK. So absolutely independent advice in relation to that. We looked at the different visa options that unfortunately are a requirement now that we live in a post-Brexit world for those that are wanting to move to Spain post-Brexit. Savings and investments, UK cited assets don't have the same tax breaks that you would have in the UK. They don't experience that in Spain. There are alternatives that provide some very, very good facilities, some good tax breaks in them. and also, crucially provide that ability to pass to future generations, spouses, etc., without going through the bureaucratic system, let's put it that way, that Spain perhaps is well known for. So avoiding that to ensure that your loved ones have access to liquid funds when they're needed is obviously a big advantage and potential benefit. And also we've touched on exchange rates, medical insurance, etc. So for everybody that attended today, we have literally just done an hour. So we thank you very much for your attendance.
Thank you.
If anybody would like to stay on and ask any more questions, we'll be available for a few more minutes to answer any more questions. So feel free to send them through on the Q&A. And if not, Paul can get his gambas a bit earlier.
Yeah, I mean, obviously, everyone has our contact details. We'll be sending emails to all attendees afterwards anyway. So feel free to engage and set up private conversations after.
Absolutely. So we will follow up. There was a couple of companies that were mentioned in the presentation that we work with. We will send details of those on. So, if you do want to or need to reach out, then you'll have those details available. Okay, if there are no other questions, everyone, then we will close today's webinar. Again, thank you very much for taking the time out to listen to us. Oh, we have one. So this one's for you, Paul. If I shift my stocks and shares ISA to alternative, how is then declared to Hacienda?
Yeah, sure. So this is basically the gain or losses generated from the sale of your individual shares that you hold currently. Okay. So you'll be on that 19-21% regime. And like I said, if you are disposing assets that will generate a loss, then obviously those can be used to offset the gains on other assets.
Okay. And I think it's also, correct me if I'm wrong here, Paul, that with these alternative arrangements, the Spanish compliant products that we're talking about, they are exempt from the Modelo 720 reporting as well.
Yes, this is the other added advantages. Right now, on your stocks and shares, you have to report the individual shares that you have, so which can be quite cumbersome. And depending on what deal you've got with your accountant, of course, it can be quite expensive. The Spanish compliant tax efficient portfolios, because they are based in the EU, they are automatically reported to the Spanish authorities on your behalf, which simply means that they've done the job for you, and it becomes very, very simple.
Indeed. Does that answer the question for you? Just while we'll get another response there, I think it's also important to mention that with inside of these products, as I sort of alluded to previously, it doesn't necessarily mean that you have to hold euro or even euro funds necessarily. A lot of the big fund structures, the Schroders, the Invesco Perpetuals, the Fundsmiths, those type of funds that you might be holding with inside of an ISA structure today, you will also have access to with inside of these European portfolios that Paul alludes to, where available in sterling as well as euro.
Yeah.
Okay. Any other questions?
Okay.
No. Okay. Well, thank you very much, everyone. We, as I say, appreciate your time, and I will close this session now. Thank you very much.
Right. Have a good evening, everyone.
Bye-bye.
Bye-bye.